is Gary Cohn, who served as National Economic Council Director during President Trump's first term. He's also vice chair at IBM and former Goldman Sachs president and chief operating officer. Yeah, but what else, Gary, have you done with your life? My God.
Thanks for having me, Liz.
Yeah, so which matters more, do you think, to the stock market? Is it a vibrant AI tech sector, or is it something more like rates coming down?
You know, rates ultimately are going to matter to everyone because rates affect every company, big and small, and they affect the consumer. So, you know, the vibrant tech sector is important. The Mag 7 is important. As you said, NVIDIA's earnings will tell us a lot about what's going on in the AI push and the AI move. But interest rates have a pervasive effect across the entire market, from the basic consumer all the way up to the largest corporations in the world.
Sure, you're talking about auto loans, credit card interest rates, et cetera. But if you start to wonder about the tech sector, that's really been the driver over this, as we said, a multi-year bull market.
Yeah. It has. Look, we are in this AI evolution, revolution, call it what you want. And we're in, you know, early stages of something that we all think is going to be enormously important and is going to be changing to our economic growth, our economic trajectory, and we're early in that game. So when you talk about how much money is being invested, how much CapEx is being invested in AI, whether it be in data centers or in programs itself or in large language models or in efficiency models where companies are actually putting AI into their enterprise to make themselves more efficient, to do tasks that need to be done and do them in a more efficient way, this is a huge seismic change in our employment and our economic picture in this country. And it's got a path to go. And ultimately, this all leads to quantum computing, which you know, in itself is a whole nother leg up from AI.
Yeah, super hyper fast, never seen before compute power. Anthropic CEO Dario Amodei is making some headlines here. He's warning today that AI is going to wipe out half of entry-level white-collar jobs of the future. I recently was at South by Southwest with ARM Holdings CEO Rene Haas. He said he was concerned about those first 5-year jobs in the white-collar world. I mean, how do you view it? You're at IBM, you're a vice chair. IBM just announced it's going to, 8,000 jobs laid off, and mostly in HR, and they'll be replaced by AI agents.
Look, first of all, IBM continues to grow. We're a growth company, so we're always hiring people in the skill sets we need to provide what our clients want from us. So when you look at technology and technological revolutions, and we've gone through many of them in this country, you know, go all the way back, you know, cotton gin, combustion engine, internet, you know, typewriter, you go through each one of these. Every time we've gone through one of these seismic moments, people have talked about losing jobs and jobs leaving the economy. What's ultimately happened? The economy has gotten dramatically bigger, because a lot of those jobs that we lose are jobs that you said are very entry level. People are highly dissatisfied in those jobs. There's high job turnover. There's high error rate. So what happens is people move from those jobs that they're not very happy having, and they get into higher skilled, higher value added jobs, and companies get bigger. They can cover more clients, and they can do it more effectively. So there is a retooling, there is a retraining curve, there always is, but ultimately AI will provide a bigger, more robust, more global economy.
It's interesting to see, though, now I'm asking you to put on your financial hat because you've ran at Goldman Sachs for so long. NVIDIA, for example.
And I'm now at Apollo as well, so
yeah,
you know, we've got
Apollo,
that as well.
Exactly. So. Huge financial names out there. And when you look at NVIDIA's year-to-date performance, it's flat to up 1%. That's year-to-date. A one-year picture, up 19%. You look at, for example, the XLF, which is the financials ETF, up 5% year-to-date, but 1 year, it's up 23%. So what is juicing the financial names?
Look, there's a lot of different things going on, but we're in a steeper yield curve environment. So we have an environment where long-dated rates have gone up, shorter-dated rates have stayed relatively lower. We've got a steep yield curve. Steep yield curves are very beneficial for financial service companies. You know, financial service companies are big banks as a whole. They take in overnight deposits, and they take them in at the low rate at the front end of the curve, and they lend them out for long duration. They lend them out to consumers to buy homes, to buy cars, school loans, things like that. And the steeper the yield curve, the more profitable it is. And banks themselves have become substantially more profitable in becoming, you know, more efficient organizations. You know, I think banks as a whole always try and run on the efficient frontier, and they have been early adopters to a lot of the enterprise technology, and that shows through in their earnings.
Well, okay, And then as you look forward to, and I know you don't sit there and pick stocks or anything, but which looks like an opportunity in the next half a year? Is it the big financials? Is it the regionals? Is it tech? Because understand.
You're right. I don't pick stocks.
You know,
You're completely right. I don't pick stocks.
A girl can ask. A girl can ask.
A girl can ask, and a guy cannot answer.
Okay.
At the end of the day, a lot of this is going to be driven by the economic cycle. And we have to have a view on where the economy is and where the economic cycle is. And I think, in spite of many people's worries in the beginning of this year, the economy has continued to be very robust. And I think the economy continues to break more to the high side than people would have thought. The employment picture continues to stay relatively favorable. The inflation picture is favorable. We've got a lot of good things going on in our economy. And if the economy stays sound, good companies, well managed, are going to do well.
Okay, speaking of breaking higher, if this so-called big, beautiful bill is approved by the Senate, goes back to the House, and it gets into law, you're looking at a $3.8 trillion add to an already $36 trillion debt, which continues to break higher. Stephen Myron, the chairman of the Council of Economic Advisors for President Trump, was on the show yesterday, and I try to push him. This is adding $3.8 to $4 trillion. Here is what he said, Gary, and then you can react.
The entire bill is going to generate revenue through generating economic growth. What the people who score these things do is they look at tiny bits of the picture without looking at the entire picture. And one of the things that they miss, and there's a bunch of stuff that they miss, but one of the things that they miss is that better economic growth brings in more revenue. Because when people make more money, when corporations make more money, when everyone in the economy is making more money because there's all the incentives for growth, then there's more tax revenue too. And this bill, the Council of Economic Advisors estimates this bill is going to produce GDP growth that's 4.2 to 5.2 percentage points higher than if the bill doesn't pass.
How does that range sound to you? 4.2 to 5 point plus?
So first of all, the last couple of words he says were really important. 4.2 to 5.2 versus if the bill doesn't pass. So I think I heard that right. So what I think he was saying is if the bill doesn't pass, we revert back to the 2016 tax code, which is dramatically higher rates,
correct,
dramatically more complexity. That will be very stifling to economic growth. So I think if you take the stifling economic growth that would happen under the old tax legislation versus continuation of the 2017 tax legislation, that could be a substantial spread.
But
I don't think we're going to have 4.2 to 5.2% growth from where we are today. So I'm not sure if he was saying from where we are today or from what would be if we didn't extend the tax cuts. And that's a very important point. So, look, I understand the point that he's making. I made the same point 8 years ago. When you score tax legislation, it's scored on what's called a static basis. No one takes into account what effect, positively or negatively, your legislation will have on the economy. Let's say, based on where we think the economy is going before you give us this piece of legislation, this is what we think the economic impact is. Now, we all know that if you put a good bill out there and it is stimulative to the economy should grow. And he's right, the tax base should increase. So revenue to the government should increase. Yeah. The flip side is if you do something negative, the economy shrinks. So there is something to be said about static versus non-static scoring. And I think there's definitely something to be said if we don't extend the Trump tax cuts, how devastating that would be to the U.S. economy versus extending them and keeping these lower rates, keeping the simplification, keeping the tax system that we've had for the last 8 years, keeping that in place.
But it's still devastating to pay $1 trillion in interest just to service the debt that we have right now.
Look, I agree with that. And so, look, part of this bill also is aimed at reining in spending. And I think the bill is now on its way to the Senate. And I think we've heard a lot out of some of the senators talking about there aren't enough spending cuts in the bill. I always say we shouldn't talk about this legislation. We shouldn't judge it till it's final. I think this legislation is far from final, and we'll see what some of the senators do as they start looking at the legislation and looking at the economic impacts and looking at the deficit impacts.
Maybe they'll hold on to the fiscal religion they say they have found, which the House, at least for the moment, kind of agreed to let go a little bit. and we'll watch it.
Well, we can hope for the best. How's that?
Don't you miss being on the Hill and trying to bang on these doors and say, come on, get this thing through?
Look, I do miss it, but look, I think we're heading in a good direction. Extending the tax cuts is really important. Reining in spending, I'd love to get back to pre-pandemic levels. It seems like we could get back to pre-pandemic levels of spending. Those things are all really admirable goals that we should work hard to get to.
Gary Cohn, great to have you.
Thanks for having me.
Thank you very much.